We are covering these 5 top stocks with big percentage moves today. While watching bullish price actions, let us inform you our review on ZenaTech Incorporated, a Canada-based technology company specializing in AI-driven drones, enterprise SaaS, and quantum computing solutions, has taken another significant step in expanding its drone-as-a-service (DaaS) division. The company has signed a letter of intent (LOI) to acquire its 6th land survey company in Arizona, marking its first acquisition in the broader Southwest region. This development signals ZenaTech's strategic intent to strengthen its foothold in the U.S. land survey and mapping sector, leveraging its advanced drone technology to enhance efficiency and precision in surveying operations. By integrating the ZenaDrone 1000 and IQ Nano into these acquisitions, ZenaTech is positioning itself as a key player in automated land analysis, infrastructure assessment, and environmental monitoring. For investors, this move suggests potential revenue growth and an expanding customer base within a high-demand sector. The company's ongoing acquisition strategy also highlights its commitment to scaling its DaaS operations, which could drive long-term value and reinforce its market position. However, the successful execution of this strategy will depend on seamless integration and the ability to capitalize on the synergies between acquired firms and ZenaTech's proprietary technologies. Market response to this announcement will likely reflect investor confidence in ZenaTech's ability to translate acquisitions into tangible financial gains. With increasing regulatory interest in drone applications for infrastructure and land surveying, this expansion could enhance the company's competitive edge. Investors should monitor further developments regarding the terms of the acquisition and potential impact on ZenaTech's revenue streams and operational efficiencies. Our review on OPRX OptimizeRx Corporation, a digital health technology company specializing in AI-driven engagement solutions for life sciences, reported strong fourth-quarter and full-year results, exceeding analyst expectations. Fourth-quarter revenue grew 14% year-over-year to $32.32 million, surpassing the $30.36 million consensus. Full-year revenue rose 29% to $92.1 million, with gross profit reaching $59.4 million. Adjusted EBITDA jumped 53% in Q4 to $8.8 million, totaling $11.7 million for the year. Adjusted EPS of 30 cents beat estimates of 27 cents, reflecting strong operational efficiency. The company ended 2024 with $13.4 million in cash and $4.9 million in net operating cash flow, reinforcing its financial stability. The company continues to strengthen relationships with major pharmaceutical manufacturers, with the top 20 pharma firms accounting for 64% of total revenue. Average revenue per top manufacturer rose to $2.93 million from $2.4 million in 2023, and net revenue retention improved to 121%, up from 105% the prior year. For 2025, OptimizeRx projects revenue of at least $100 million and adjusted EBITDA of $12 million, positioning itself for sustained growth in digital healthcare marketing. With increasing demand for its AI-driven solutions and strong client retention, the company remains well-positioned for long-term expansion. Investors will monitor execution and further client acquisitions to gauge upside potential. Our review on SPP. Scripps Company, a diverse media enterprise with a portfolio of over 60 local television stations and national news and entertainment networks, delivered a strong fourth-quarter performance, exceeding analyst expectations and demonstrating significant year-over-year growth. The company reported adjusted earnings per share, EPS, of $1.01, surpassing the consensus estimate of 98 cents by 3.06% and marking a dramatic improvement from a loss of 2 cents per share in the same quarter last year. Quarterly revenue increased 18.29% year-over-year to $728.38 million, exceeding the expected $724.04 million. This strong revenue growth underscores Scripps' ability to capitalize on increased advertising demand, audience engagement, and its expanding digital and streaming platforms. Scripps' local media segment, which includes more than 60 television stations reaching approximately 25% of U.S. households, continues to benefit from a strong political advertising cycle and local news viewership. Meanwhile, the Scripps Network segment, which includes national brands such as ION, Bounce, Court TV, and Scripps News, has contributed to revenue growth through its extensive reach via free over-the-air broadcast, cable, satellite, and digital platforms. The company's strategic focus on expanding its over-the-air television presence has positioned it well in an evolving media landscape, particularly as more viewers shift away from traditional pay-TV subscriptions. This earnings beat reflects Scripps' success in optimizing operational efficiencies, monetizing its media assets, and leveraging audience expansion across multiple platforms. Looking ahead, investors will be watching how the company sustains this momentum amid changing consumer media consumption trends and fluctuations in advertising spending. If Scripps can continue capitalizing on its strong content portfolio, political advertising tailwinds, and digital distribution, it could drive further revenue growth and shareholder value. Market sentiment will likely remain positive as long as the company demonstrates continued profitability and audience retention across its media properties. Our review on GRPN. Groupon Incorporated, a scaled two-sided marketplace connecting consumers with merchants across local services, goods, and travel, reported mixed fourth-quarter financial results, showing both challenges and signs of momentum heading into 2025. Fourth-quarter revenue came in at $130.38 million, beating analyst expectations of $127.74 million, though it declined 4% year-over-year. Gross billings totaled $430.1 million, down 1% from the prior year, while unit sales dropped 8% year-over-year but improved 18% sequentially. The company reported a larger-than-expected loss of $1.20 per share, significantly missing estimates of a 4-cent loss. Despite these headwinds, Groupon demonstrated strong cash generation, with $67 million in operating cash flow and $63.2 million in free cash flow, ending the quarter with a solid cash position of $228.8 million. Management highlighted a turnaround in North America Local, which grew 8% in billings, marking a key milestone in its transformation strategy. Groupon's strategic focus for 2025 includes strengthening key markets, enhancing customer retention, increasing merchant success, and finalizing its mobile-first platform migration. While the company expects first-quarter revenue between $114 million and $117 million, it anticipates a slight decline in billings of 2.5% to 5%. However, full-year guidance suggests stability, with billings projected to grow 2% to 4% and revenue expected to be flat to up 2%. Investor sentiment will likely hinge on Groupon's ability to sustain North America Local growth, improve profitability, and execute its transformation strategy effectively. If the company can continue its operational improvements and drive engagement in key categories, it may position itself for a more sustainable long-term recovery. Our review on SNCR. Synchronoss Technologies Incorporated, a provider of white-label cloud, messaging, and network management solutions, delivered a strong fourth-quarter performance, significantly outperforming analyst expectations and demonstrating substantial year-over-year growth. The company reported adjusted earnings per share, EPS, of 94 cents, a staggering 944% increase over the consensus estimate of 9 cents and a major turnaround from a loss of 85 cents per share in the same quarter last year. Quarterly revenue reached $44.21 million, slightly exceeding the $43.76 million estimate and marking a 6.78% increase year-over-year. This strong earnings beat underscores Synchronoss' operational improvements and cost management efforts, which have driven profitability despite modest revenue growth. The company's Synchronoss personal cloud platform continues to be a key driver of its business, helping telecom operators and service providers boost customer engagement, increase ARPU, and reduce churn. Additionally, its advanced messaging platform remains well-positioned to support the expansion of rich communication services, RCS, and next-generation messaging solutions for service providers. Synchronoss' ability to generate such a dramatic earnings rebound highlights its progress in optimizing its business model and increasing efficiency. Investors will now look for sustained profitability and revenue expansion as the company continues to enhance its cloud and messaging offerings. If Synchronoss can build on this momentum and further strengthen customer adoption of its platforms, it may continue to improve stock performance and long-term growth prospects. Please subscribe and give the video a like and check out more from our playlist. Thanks.